So you've finally got some money to invest, and you're ready to stop hoarding cash like a doomsday prepper stuffing it under your mattress. Good move. But now you're staring at two fancy-sounding options: index funds and mutual funds. And let me tell you, they may look like siblings in the finance family, but they live on completely different ends of the neighborhood. One is chill, low maintenance, and quietly building wealth in the background, while the other is flashy, high maintenance, and charges you just for looking at it. The big question is, which one actually makes you rich? Which one is stacking compounding returns while you sleep? And which one is draining your wallet with sneaky little fees that feel like a bad subscription you forgot to cancel? Let's break it down. Mutual funds are like that overconfident guy at the gym who flexes in the mirror, swears he knows what he's doing, but still skips leg day. They're actively managed, meaning there's a human sitting in a corner office, wearing a tailored suit, carefully picking stocks and bonds on your behalf. On paper, that sounds like a dream. A professional doing all the heavy lifting for you. The problem? That professional is charging you anywhere from 1% to 2% every single year, whether they beat the market or not. And here's the kicker: most don't beat the market at all. Over the long run, the majority of actively managed mutual funds underperform, which means you're paying top dollar for worse results. And let's not forget the loads. And no, not the kind of loads that sound exciting. These are front-end loads, back-end loads, 12b1 fees, basically a long list of gotcha charges that make you feel like you're paying a cover fee to get into a party where the drinks are warm, the music sucks, and someone keeps passing around expired chips. By the time you realize what's happening, the manager is already pocketing your cash while blaming the market conditions. Now compare that with index funds. Index funds are the cool, low-maintenance friend who shows up in sweats, nails the test, and doesn't brag about it. No drama, no ego, no trying to outsmart Wall Street. They simply track a market index like the S&P 500, which means you automatically own a piece of 500 of the biggest companies in the US. Apple, Microsoft, Amazon, Google, even Tesla, if you're into watching Elon Musk cause chaos on Twitter while your shares quietly grow in the background. Instead of betting on one person's genius, you're betting on the economy itself. And history has shown that the economy, despite recessions, crashes, and pandemics, always trends upward over time. And here's the best part: fees are practically non-existent. We're talking 0.03% to 0.1% expense ratios, which means that on a $10,000 0-cents investment, you're paying just a few bucks a year. That's cheaper than a cup of coffee at Starbucks. And unlike your latte habit, it actually grows your money. Compare that with mutual funds, where you might be handing over $200 0 cents every year on the same $10,000 0 cents just for the privilege of letting someone underperform the market for you. When you put those side by side, it's like choosing between buying a luxury car that breaks down every month and a reliable Toyota that never quits. One looks cooler in the short term, but over the years, the humble choice gets you further down the road with way less stress. And performance? Oh, this is where it gets fun. Over the past 20 years, index funds have beaten 80–90% of actively managed mutual funds. That's not a fluke, that's a massacre. Imagine paying someone a premium to pick hot stocks and then watching them lose to a robot that just blindly tracks the market. That's the reality. And I'll admit it, I learned this lesson the hard way. Back when I first started investing, I thought I was being smart, so I threw my money into a flashy mutual fund that had a glossy brochure, a slick name, and a fund manager who looked like he could sell ice to an Eskimo. For a while I felt fancy, like I was part of some elite investing club. But after a year, when I checked my returns, the only thing that was elite was how much I paid in fees. The growth barely beat inflation. Meanwhile, my boring little index fund that I had tossed a smaller amount into was quietly compounding, reinvesting dividends, and outperforming the shiny mutual fund with zero stress. Over the years, that gap only widened, and it became impossible to ignore. The index fund kept winning, consistently, with lower fees, less drama, and No slick-talking manager sending me quarterly letters about how next year will be better. And this is where compounding steps in and flexes. When you invest in index funds and let them ride, every single dividend gets reinvested, and your money starts multiplying in the background while you live your life. Compound interest doesn't care if you're sleeping, traveling, or binge-watching Netflix. It just keeps working. A 1% fee difference doesn't sound like much, but over 30 years it can cost you hundreds of thousands of dollars. Mutual funds love to downplay that, but math doesn't lie, and when you run the numbers, it's brutal. Now, are mutual funds always bad? Not exactly. In some retirement accounts, like 401ks, your choices might be limited. And some mutual funds can come with tax benefits, or strong long-term managers who do add value. But for the average investor who just wants to grow wealth without headaches, index funds are the undefeated champs. They don't need to impress you with predictions. They don't need to justify their existence with endless fees. They just quietly do their job year after year, decade after decade, building wealth in the background. And if you zoom out, the results speak for themselves. The index fund crushed the mutual fund in my own portfolio every single time. Less drama, better growth, lower fees, and way less stress. No endless meetings with a financial advisor. No fancy charts. No worrying about whether the manager made the right call. Just automatic growth, powered by the simple truth that the market over the long run always goes up. And that's the beauty of it. You don't have to be a genius to win with index funds. You just have to be consistent. Buy a solid index fund, reinvest the dividends, and leave it alone. That's it. Do that for 10, 20, 30 years, and the power of compounding will do the heavy lifting for you. Meanwhile, the folks in mutual funds will still be paying 2% a year to lose to the market. So if you're serious about investing, stop chasing the flashy options. Don't get seduced by glossy brochures or the promise of market-beating returns. Instead, play the long game. Pick a broad, low-cost index fund, keep adding to it, and let time do its thing. The smartest money in the room isn't the loudest, it's the quietest. The money that just sits, grows, compounds, and doesn't demand your attention every second. And when you look back decades from now, you'll realize the boring choice was actually the brilliant one. So the final answer? Index funds all day. They made me more money, gave me better peace of mind, and cost me practically nothing. If you're ready to invest smart, keep it simple. Go index, stay consistent, and let compound interest turn your small beginnings into something massive. And if you found this breakdown helpful, and you're ready to build your own money machine, smash that like button, hit subscribe, and drop a comment saying, "Index greater than everything." Because when it comes to building wealth, sometimes the quietest strategy is the one that makes the loudest impact.